I'm John Hanna for CDTV.net in New York, and we have Dirk Dijk, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio. Hey, Dirk, good afternoon.
Good afternoon, John. How's everything there?
It's okay. It's kind of cloudy a little bit, but it's okay. How about yourself? How's the weather out there?
A little bit cloudier here. Last night it was pretty wild, though. Some pretty wild and crazy thunderstorms around here. Fortunately, no tornadoes like they had in Missouri.
Right. I mean, those are becoming worse. I mean, it's like a lot of natural phenomenon happening worldwide.
Yeah, that it is. It's been a pretty brutal tornado season. That's certainly for sure.
Yes. So, Dirk, what do you have for us today?
Well, we got new home sales this morning, and new home sales is, I think, a very, very important number these days because it really provides the key to the whole residential investment space, and that's been the biggest drag on the economy for the past 4 or 5 years now. I mean, we've shrunk from residential investment being almost 6.5% of the economy down to about 2.2% of the economy, and historically it's residential investment that really leads us out of recessions, and it just isn't happening this time around. But we did get some sort of marginally good news. I mean, it's good in terms of the direction. The absolute level, though, is still a disaster. The new home sales in April ran at an annual rate of 323,000, and that's up from the March rate of 301,000, which is revised up from 300,000. So that's a 7.3% increase, which is pretty respectable. On a year-over-year basis, it's still really ugly, down 23.1%. But if you remember back to what was going on a year ago, we still had that first-time homebuyer tax credit, and actually, by the time it got to this, it had been expanded to just a homebuyer tax credit, not just first-timers. So that was sort of inflating things because people were rushing to get in under the wire to get that tax credit, and new home sales generally are recorded a lot earlier than say the used home sales, which are recorded at closing. So April was really, a year ago, was really the month where you had the maximum effect of the new home buyer tax credit. Sales then collapsed in May. So looking at the May numbers, we'll probably have a pretty easy comp. But the 323,000, while that's a nice increase, you got to realize that every month in the last year has been one of the 12 lowest monthly new home sales on record, and those records go back to the Kennedy administration. And the U.S. population is a heck of a lot bigger now than it was under Jack Kennedy. And with more people, one would expect that they need more places to live. So the level is absolutely distressing. But at least it looks like we're starting to move in the right direction. And we've been averaging under 300,000 over the past year, and so at least we're getting up above that level. Every one of the 4 census regions posted an increase in sales, the strongest being out west, where sales were up 15.1%, followed by the Northeast, up 7.7%. The Midwest was up 4.9%, and the South up 4.3%. And that was, led to an increase in the average price of houses, which the median price rose to 217,900 from 214,500 last month, and up from 208,300 a year ago. And that's sort of like the first good news that we've had on the housing price front in a long time. But don't read too much into that, because the West and the Northeast are much higher priced housing markets than the Midwest and the South. So if you're seeing much stronger gains in those higher priced regions, really is more about mix than, all of a sudden housing prices starting to go up. Similarly, the average price, which is always going to be higher than the median price for housing, posted a very nice gain, especially in the month, rising to 268,900 from 250,000, but still down slightly from a year ago when it was 270,500. But it's encouraging to see at least some positive numbers on the housing price front. The other good news on the new housing price front is that the absolute level of inventories continues to shrink pretty rapidly, down to 175,000 from 180,000 last month and 217,000 a year ago. The level of inventories in absolute terms has been falling every month for at least 28 straight months. The number I was on the press release didn't go back further than that, but looking at a graph of the numbers, it looks like we've been pretty much headed down for over 3 years now, probably 3.5 years, in terms of the number of houses in inventory. I can't make the statement. There was not one little blip in there somewhere, but there's been a very strong long-term decline in the number of houses in inventory, and so we're having a very low additions to the new housing supply, and that also goes for the starts of multifamily apartment type units. So that's going to lead to a more rapid absorption of the available supply, and eventually start to cut into this huge overhang that we have of existing home inventory. Existing homes came out last week, and they were pretty disappointed. They were actually down 0.8%, and the inventories actually were rising, and there the months of supply is up to 9.2 months from 8.3 months in March, and that's a very unhealthy level, and something that you're got to be quite concerned about, because that sort of level of inventory is putting downward pressure on housing prices. I mean, it's not so much the level of turnover of existing houses that matters. It's almost like selling used. Does anybody track used car sales? No, because you're not producing a new car. It's just transfer of it, an existing asset. The same is true with used homes. But new home sales represent an awful lot of economic activity. You think about the people working to construct that house, all the materials that go into the house, and the workers that have to produce that, the lumberjacks, the people working in the factories that produce, cabinets and faucets and wallboard and all of that stuff. And so it's really important to track the new home sales, even though they're a much smaller portion of overall home sales than existing home sales, and a much smaller than normal portion of total sale. In normal times, usually there are about 6 existing home sales for every new home sale, but now it's running more like 15 to 1. We had in April, we're running at an annual rate of 5.05 million existing home sales, but we're only talking 323,000 new home sales. So there's a big gap compared to the normal relationship between new home sales and existing home sales. But and existing home sales, always are a much bigger portion of overall sales. But in terms of economic activity, it really is the new home sales that you have to be looking for. And so I do find it very encouraging that we're seeing a rise in new home sales. But we really haven't broken out of what's been a pretty lousy band for the past year. We're sort of approaching that top end of that band, but in the absolute level is still something very worrisome. If we can continue this trend that we've seen in the past few months, that's going to be very helpful in trying to get the economy moving again. And eventually it's going to happen. The timing is very uncertain, but you can't just go on forever not adding new houses when you've got a growing population and the existing housing stock, some of it deteriorates, burns down, gets bulldozed year over year. Plus, you've got the population moving around, and a used house in Detroit is not a very good substitute for a house in California or Florida or Alabama or Tennessee. I mean, it's a fixed location, and so if people are moving, then you're going to build new housing for those people. But we still have an awful big overhang. But slowly it's getting worked away. And when that happens, it is going to be a very big, serious boost to the overall economy. New home sales and residential investment are a very volatile part of the overall economy, and as a result, they tend to punch above their weight class an awful lot in terms of whether the economy is doing well or it's in recession. And this has been a very unusual recovery in that we have not yet seen a recovery in residential investment, which would then filter through to the rest of the economy. And I would go so far as to say it is the key reason why we've had such a sluggish recovery. I mean, directly, construction has accounted for a quarter of all the jobs lost in this downturn. And it only at the peak represented about 6.5% of all the jobs. So that's a huge imbalance, and that's not even counting a lot of the other jobs that are tied to housing that are not directly construction-related jobs. I mean, for example, all those factories that create building materials, that's counted as manufacturing jobs. The lumberjacks that are out of work, clearly that wood is being used to make housing, but it's not counted in those job losses. So there are an awful lot of indirect job losses that have come from the downturn in housing. So once we get that rolling again, you're going to see a lot more income growth, and the economy will get a lot stronger. And I'm hoping that what we're seeing is just a little inkling of that starting. But I think we're going to need a couple more months of these sort of gains before we can really be confident that that's happening.
That's Dirk Van Dijk, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio, and I'm John Hanna for CDTV.net in New York.